when the events have to be implemented in the future, so there is a plan taken up for the future. So according to the plan, whether things are implemented or not also has to be verified. So planning and control, so we've discussed that earlier also, that planning and control has to go together. Then if that is the case, so whatever is planned and what is actually implemented are compared. So that's the same concept even under budgeting also. But then here under standard costing, we see that the planning is taken up in terms of the standards are decided. So the standards are decided as to what should be the course of action implemented in the future. So standards. So one set of standards are decided for revenues or income or sales. Then another set of standards are decided for the cost. What should be generated as revenue is one thing. So one set of standard is decided for revenues. Another set of standards are decided for what are the costs, the various costs, and what amount of cost should be incurred. This is only a plan, the standard which is decided. But things may work out according to the plan or may not work out according to the plan. If they do not work out according to the plan, what is the variance is what has to be looked into. So we need not understand that variance is always in a negative sense. Maybe when they have decided that they would spend the cost which will be required is 50,000, but in reality they might have spent only 48,000. So that is a favorable thing. So they were prepared to meet a cost of 50,000, but while spending the amount of cost, it was only 48. So 2,000 is a favorable indication. Or if they spend more than 50,000, it's an unfavorable thing. So here we see that the variance could be both favorable and unfavorable. Okay. So we need to understand there are certain intricacies which we need to remember while we do that. So the a pattern in the PPT would go one by one, but if wherever I need to elaborate, connect it, I will put it across and then I'll help you to remember the way in which these variances have to be remembered. First, if we begin with the revenue variances or the sales variances. What is sales in simple terms? Sales is equal to the number of units sold into selling price. So there are only two variables which have to be included to find out the value of sales. So sales value is equal to number of units into selling price per unit. So number of units, actual number of units sold into standard selling price is the standard. Then what is the variance which we are talking about? So if this is the standard, so here it is given, this would be standard, but in reality they might have sold some other thing. So this is actual. So there's a comparison between actual and standard. And the difference, if there is any, between the actual and standard is called a variance. That could be a favorable, that could be an adverse thing. So there is no standard way in which we write actual minus standard or standard minus actual. There is no such thing as such. We can write in any order. The logic is what we have to remember. In case of revenue, the actual revenue should always exceed the standard revenue. The performance should be better than the standard. Then it is a favorable thing. If the performance is not up to the standard, it is unfavorable. If it is not up to the standard, it is unfavorable. It is equal to standard, it is indifferent. It is more than the standard. They were supposed to sell 50,000, they ended up selling 51,000 units. Is a favorable thing. Their performance is better than what they have planned. Okay, so that is how the variance is calculated. So in total, if we have to find out what is sales variance, the actual sales minus the standard sales gives us the sales price variance. What are the reasons? have a look at what are the reasons for every in every step, every area. You have to remember this one. Why is there a variance for each type of variance which we would be calculating? We need to know what are the reasons for the variances. First one, higher than expected discounts offered to customers to persuade them to buy large bulk orders. We know that when the units purchased or units sold are at a large scale, the price offered is at a different rate. The discount, there is a discount which is offered because the sale happens at a bulk quantity, or the purchase happens at a bulk quantity. So here when we talk about sales revenue, so it would be obviously the number of units sold. So if the number of units sold are at a large scale, so that's at a bulk order, so the selling price per unit would definitely be lesser than what actually they have planned for. Sales is equal to units, the number of units into selling price per unit. The number of units into selling price per unit. This is sales. Sales is equal to number of units into selling price per unit. When these units are increased, so to act as an or to provide some kind of incentive to the customer, the selling price is brought down. So here, if the discount which is offered is having an impact on the total sales value, then there would be an unfavorable negative variance or an unfavorable adverse variance which can happen. So what they have planned, what would be the sales, what they have planned, and what actually is the sales, these two things when they are compared, if their discount which they have offered is more than what they anticipated, then one reason is that there could be an adverse or a negative or an unfavorable variance. Lower than expected discounts, perhaps due to strength of sales demand. So another situation, it could be a favorable thing because they have not given any discount. Though the number of units sold are high, the demand is more, but the selling price was constant. They have not given any discount. So then what happens? Their overall sales would increase. When the sales increase, their actual performance is better than the standard performance. Then there would be a variance, but this time it is a favorable variance. Then the effect of low price offers during a marketing campaign, low price offers. So they have to attract the customers, they've given discounts to the customers. Then unexpected price increases or cuts. So maybe because the selling price in the market was otherwise also increasing because competitors were rising, or some possibility, or the competitors were giving a discount, they were also compelled to give a discount. So according to the changes in the market, if they also have followed, on account of that, if there is any change in their selling price, on account of that also there could be a variance. Okay, so here we see that these are the causes which are mentioned for variances in sales price variance. So focusing on the price part of it. Then the next set of variances are the volume. Volume is what? The number of units which are sold. So the sales volume variance, it talks about actual units sold into standard margin per unit. Then budgeted units sold into standard margin per unit, and the difference between these two is the sales volume variance. There is a term which is used as margin. There is a star mark also given. You also have to remember what is this margin. How is the margin mentioned? The standard margin will be the standard profit if using absorption costing, and the standard contribution if using marginal costing. Okay. By now, you have already learned about what is the difference between absorption costing and marginal costing. So first we need to look into what is the method which is followed. If they are following absorption costing, the profit will, the margin item will be profit only. Profit is sales minus total cost is profit. But if it is marginal costing, you know that only the variable cost is deducted, which is also called as the contribution. Okay, so take the contribution margin and then include that. So the volume variance will be the profit margin, whatever is the profit margin, into the difference between the number of units. So in simple terms, we can put it as the standard margin Okay, how do we, I'm sorry about it, how do we present a volume variance? Technically speaking, volume variance is the difference in the volume, whether the actual units, so I'll put it as actual quantity or actual units, and the standard units, they are compared. Both of them have to be compared. Whether the number of actual units sold is more than the standard units which are planned, or the standard units which are planned are more than the actual quantity which is sold. So technically we need to find out the difference between these two. Then that is applied at the standard profit. So when we are talking about the volume variance, volume is nothing but the quantity. So we have to find out the difference between the actual quantity and the standard quantity. Any order you put it, it doesn't matter. The only thing is, in case of variances, the actual should be more than the standard. In case of cost variances, standard should be more than the actual. That's the only point what you have to remember. You can write it in any order. So this variance, that is variation in the actual quantity and standard quantity, should be applied for the um, applied at the total standard profit rate. Profit rate, again, you have to remember whether it is absorption costing or marginal costing. That part you know that. In case of marginal costing, they depend on the controllable profit. Controllable profit is sales price minus variable cost. That is the controllable profit. So that is what we have to remember. But what was it in case of the price variance? The first one is the price variance. So here we need to understand that there is a, for this one, the first one, the price variance would be the difference in the actual price and the standard price. If we put it in an equation form, actual price minus standard price, the variation applied for the actual number of units which are sold. So actual quantity, the actual number of units which are sold. So that is how we present it in a single formula, single equation format. Okay. Then we still have to learn something more about the um, sales variances. But as of now, we will now start. If you have this particular basic thing, basic equation is sales is equal to the number of units into selling price per unit. So number of units, the variance could be on account of a difference in the number of units what are planned and actually sold, or the difference could be because of the prices or because of the profit margin applied for the difference in quantity. It could be anything. So we still have to look into some more sales variances, but then that we will take it up little later. As of now, we'll start with the cost variances. So I'll take you to a word file and then we'll come back again to this one. Um, you can understand this particular thing. One information, Monday, you won't have my class. And from Tuesday until Friday, I don't know whether you have the information, but you will have my class only for 1 hour, 4 to 5. That's starting from Tuesday till Friday. Monday there would be no class. I hope that's clear.
Yes.
Yes, ma'am.
You got the information?
Yes, ma'am.
No. 1 second. Is there any possibility that we can have it in the morning?
We have college from 9:30 in the morning.
Okay. Did the semester start just now?
Ma'am, our semester is going to end in 1 month.
Semester?
Our fourth semester is going to end in 1 month.
Okay, okay. Okay. But then in the another 2 semesters only are there. Then you have to learn many more papers, no? This is still only P2. Then everything in for the cost variances, the criteria what is taken is based on the elements. The elements are mentioned as the variances are calculated for material. Then we have labor and we have the overhead variance. Now, for material and labor, it would be the same thing. What I'm putting it on that. Overhead variances, slight differences would be there. I will highlight you when we look into that. So, if we are talking about material variances, how are these material variances calculated? To begin with, the total material cost variance has to be calculated. So, material cost variance. So, we also call this one as MCV. What does this do? It finds out the difference between what is the standard cost of material minus the actual cost of material. In any order, you can write that. Standard cost of material minus actual cost of material gives us the material cost variance. How do we know what is standard cost? Standard cost would be standard quantity into standard rate. The number of units of the standard material, standard quantity into standard rate minus actual quantity into actual rate. This is how it is calculated. So we see that there are two components. One is a quantity component, another one is a rate component, rate or price, whatever we mentioned that. So we are using to find out the total cost, the number of units or the quantity, and the rate per unit or the price per unit. These two things are taken into consideration. We can elaborate this material cost variance further as I'll just erase this one. I think the screen is not moving along with this one. So I'll just um, write it very close to that because I need to further elaborate on that. So close to this one, we have the next one is material. There are two components I said. So there is material price variance and the quantity part of it. So the material quantity variance, whatever is the terminology which is used according to CIMA, we will also adjust according to that. But first understand the logic part of it. The material price variance is the difference between the price. Just now what we have looked into under sales price variance. So here we find out what is the difference between the standard price. The variance could be because of the price alone. So standard price minus actual price applicable for the total number of actual quantity. So the actual units which are sold, and these units applied whatever is the price variance, on account of that is there any variance in the total cost variance. So that's one point. Or it also could be on account of a difference between the quantities, that is the standard quantity minus the actual quantity. Standard quantity minus actual quantity, this, the differences in the quantity applied at the standard rate. So here it would be the standard rate. Then we see that the quantity variance can be further split into, um, there is mix variance, but I think for you it is not covered about the mix variance and the yield variance. This is material mix variance and this is material yield variance. If we have questions related to material mix variance and yield variance, I will give the formula little later, but as of now you just understand. So material cost variance is the difference between the standard cost of material minus actual cost of material, and that can be further understood or elaborate it or get into the details about, is the variance because exclusively on account of the prices, difference in prices or the variance in prices, or is it on account of the quantity, the volume variance. Okay, so that is how it is split into that. An easy way to remember the formula also. So we see that material price variance is equal to the difference between the two prices, standard price and actual price, applied for the actual quantity. In case of material quantity variance, the difference between the standard quantity and actual quantity applied at the standard rate. That can be further elaborated on material mix variance and yield variance. I said labor variance is also the same. So if we put it as labor cost variance, so um, if it is labor cost variance, so we write it as LCV, labor cost variance. The formula is the same, standard cost of labor minus actual cost of labor. Standard cost of labor will be standard hours. It is not quantity, it is the time which is used. Standard time, standard hours into standard rate minus actual hours into actual rate. Okay, that can be split into two, the standard rate or the standard price minus actual price applied for the actual hours. Wherever quantity is there, the quantity would be replaced with the hours, or some situations it is mentioned as time also, either hours or time. So the quantity part of it has to be replaced with the hours or time. Then the rate, the quantity variance will be the difference in the actual hours and the standard hours applied at the standard rate or standard price. That is how both material variances and labor variances are calculated. So let's get back. Once I go to the PPT and come back, this would be erased. It will not be there on the screen. Okay, so if you have to make a mention of that, please make it because it would not be there on the screen. Once we shift the windows, on shifting the windows, whatever was written in the previous window, it gets erased. Okay, so let's go to the PPT. To begin with, it starts with what is the material variances. Material variances. The total variance is split into the price variance and the usage variance. The total variance we have done the other way around. We have done in a vertical fashion. This is given in a horizontal fashion. So here the material variance, the total variance is split into the price variance and the usage variance. So here it says that when purchases is equal to issues and or the price variance is calculated at the time of issue, if there is a change in material stock in the year, then the price variance is based on the quantity of material purchased. This we will see this particular thing, but for the moment, as we are going with the explanation, this part will take it further. So, material could be the total material which is purchased or the total material which is used. There are two different things which can be looked into. So, here it says that if there is a change in material stock in the year, then the price variance is based on the material purchased, while the usage variance is based on the actual quantity used. At the time of purchase, that is the price variance depends on the price purchase, the quantity purchased. But the usage will be, the volume variance will be based on the usage. So that once again, when we are working out the questions, I will remind you. For the moment, you just remember that the total material cost variance is a component, has two components, is a total of two components, which includes the quantity and the price. So that is split into usage or volume or quantity variance and the price or the rate variance. Then we see SQSP there, AQSP is there, AQAP is there. What are these terms? Okay, what do they mean to say that? SQSP stands for, you can also make a note of it in your notebook. SQSP stands for standard quantity, standard price for standard quantity. Standard price for standard quantity. I'm really sorry. Standard price for standard quantity. Next, we have standard price for actual quantity. Standard price for actual quantity. Then we have actual price for actual quantity. Actual price for actual quantity. Let's say that at the time of deciding the standards, I'm just giving you the explanation of what these things mean. Let's say that at the time of deciding the standards, maybe they have decided that for every 100 units, for every 100 units, the details are as follows. So the price would be price is equal to something is mentioned. So this is how they have planned. So you say that for first 100 kilometers it would be this one, or some um, so at the rate of for every 100 it would be 50 or something like that. When you mention that, you're deciding a standard. But there can be many more hundreds in the quantity which actually is taken up in the future. So this is an example. It could be for every one single unit or something like that. So if that is mentioned, the standards only are given. The standards are given for every 100. Let's say that the actual has taken place. The actual activity has taken place at, let's put an example, 10,000 units. 10,000 units. Can we compare 100 and 10,000 units? Are they possible to be compared? They are not possible to be compared. So whatever are the details which are mentioned, they are at a value of 100 units, at a quantity of 100 units, not possible to be compared with actual. In that case, what we need to do is, first everything should have to be adjusted according to the actual activity which was taken up. The actual activity which was taken up during the period according to this example is 10,000 units. So then step number one is we need to find out what is the standard price of the standard quantity is what is given, has to be adjusted as what is the standard price according to 10,000 units, according to the actual quantity. So this is standard price for standard quantity. That has to be moved to standard price for actual quantity. So if the actual quantities are on par, both of them are on par, if both of them are discussing about an activity level which happened at 10,000 units, then the comparison and the variances make some sense. Otherwise, it is absolutely of no relevance. Some standards are mentioned at some quantity level, actual activity has happened at another activity level. They are not comparable. When they are not comparable, it doesn't make any sense at all. Okay, so then we adjust them and then take them up for analysis. What are the reasons for variances? Let's look into that. The causes could be because of price variance or because of usage variance. The price variance, what are the reasons? Using a different supplier. So if a different supplier is taken, there would be a variation in the price. What they have initially planned and what actually happened, there could be a variance. Okay, so a different supplier is selected. Buying in larger sized orders, that I already discussed. Bulk purchase discounts are offered if the purchase is on higher quantity. So there would be a variation in the price and that will result in a variance. An unexpected increase in the prices charged by the supplier. Suddenly this was not anticipated, but suddenly because of some reason the supplier has increased the price. So therefore there would be a variance, material price variance. Then a change in material quality. If it is a superior quality, less quantity would be consumed. If it is inferior quality, lot of material gets wasted and the usage would increase. When the usage increases, then we see that more quantity has to be purchased. Okay, then what are the reasons for the usage variance? Examples are given. Change in rate of scrap or wastage. Sorry about it. Sorry, I had to attend a call. Um, yeah, we're discussing about the usage variance examples. Change in rate of scrap or wastage. So there is a provision for wastage generally, um, because of the production process. It is anticipated that some part of the material gets wasted. That is maybe during the process it uh, I mean falls down on the way, or it leaks, or it evaporates, or things like that, depending on the nature of material. So there is a provision which is made for normal loss or wastage. That is a provision always created. Then that is how do they anticipate? They anticipate based on the past experiences. So it is only an estimated, and it is not necessary that it would be exactly according to the estimation. What they have estimated and what actually the loss happened, if there is any difference in that, then also there could be a volume variance. Then use a different quality of material, so uh, more quantity will be consumed if it is a cheaper quality. So cheaper quality, the only advantage is it comes at a cheaper rate. So there, at the time of rate, we see that the actual rate is less than the standard rate. That is one thing. But eventually, we see that the impact is there on the quantity. Cheaper quality material, inferior quality material gets wasted a lot, and then more quantity will be consumed. So on account of the quality aspect, also we see that there is a variance that is seen both under price variance and also under volume variance. Then better quality control or more efficient work procedures. Therefore, things would be on a favorable side. Then changing the labor mix. Labor mix is a situation where when I have given you the classification, I said the material cost variance is classified into price variance and usage variance. The material usage variance is later on, it would be um, classified as mix variance and yield variance, but I didn't give you the formula. So what does it mean by mix variance? See, to produce the output, it is not necessary, it is not always that only one type of raw material is used to produce the output. To produce the final output, they may require more than one type of raw material. So let's say material A, material B, material C are needed to produce product X. There are three different input components which are used to manufacture the final output called as X. The proportion of these materials when they are decided, they should be consumed in the same proportion. But at the time of actual implementation, the actual consumption of material, it may not be according to the standard proportion of material which is decided. It could be different. If it is different, if the proportion of material, if it is any different, then we see that there will be a difference in the usage variance. Usage is split into what is the input, yield variance is the output. What is the input variance and the output variance. Together it is the usage variance. So if there is any change in the mix, if there is any change in the mix of material, at that time we see that there would be a usage variance occurring. So that is, it could be a favorable, unfavorable. But if there is any variance in the mix in case of material, it is the various types of raw material used. But in case of labor also are various types of labor. Labor types are the skilled labor, the semi-skilled labor, the unskilled labor. Okay, so there also what is the proportion of these labor, the say skilled, semi-skilled and unskilled labor, that also has to be taken into consideration. everything is the same under labor also. The labor, the total cost variance is divided into the price variance and the usage variance. In case of labor, we do not use the term called as usage variance or quantity variance. We use the term called as labor efficiency variance, LEV, labor efficiency variance. That talks about the difference between the actual time and the standard time applied at the standard rate. Then labor rate variance is the difference between the actual rate and the standard rate applied for um, the actual quantity. Okay, so that is again considering the standard rate for the standard hours, standard rate for the actual hours, actual rate for the actual hours. So that we will look into that. Everything under the material variance and the labor variances is the same, except that under labor variance we have one more additional variance which is called as ideal time variance. By default, ideal time is always a unfavorable variance. So because on account of idle time, the productivity gets affected. So if there is idle time, there is no production which is carried on. So that is an unfavorable scenario. So idle time variance is always a negative variance or an unfavorable variance. How do we calculate? Just take the ideal time number of hours and multiply into the standard rate per hour, and take that and apply it for the idle time, whatever is the idle time. So here it is elaborated, and it says idle time variance is equal to actual hours worked into standard rate per hour, actual hours paid into standard rate per hour. The difference between these two is idle time variance, because they have accounted for the time, the total number of hours which are worked, and what are the hours for which they are paid. So when the worker is there in the factory premises, for all the number of hours which he spends in the factory premises, he is entitled to receive a wage. But out of that, because of certain unproductive hours, which we call that as idle time, he is paid wages, but there is no production, there is no productivity in those hours. That is an unfavorable. In all situations, it is an unfavorable wages. So the difference between the total hours for which the worker was paid minus the hours which he actually worked, the productive hours. The difference between these two things talk about what is the ideal time. So ideal time is multiplied into standard rate per hour, and we get that as an unfavorable or an adverse variance. We see that what are the causes of these variances. An unexpected increase in basic rate of pay. So the labor variance, why would there be a variation? Because there is an increase in basic rate of pay. They are entitled to payment of bonus, where there are these are recorded as direct labor hours. Using labor that is more or less experienced, different types of workers, skilled workers or semi-skilled or unskilled workers. Then what are the typical causes of idle time variance? It says that industrial action by the workforce working to rule. Maybe it was highly unionized, therefore the interference of unions would be there, and on account of that they are entitled to have entitled to be free for some time, having no work in those hours. Okay, then there's no supervision, poor supervision, unexpected lost time due to production bottlenecks and so resource shortages. So these are the reasons why there would be idle time arising. And what are the reasons for efficiency usage variance? Taking more or less time than expected to complete work due to efficient or inefficient working, using labor that is more or less experienced, and so more or less efficient in the than the standard, a change in the composition of mix of the workforce, and so a change in the level of efficiency, improved working conditions, improvement in efficiency due to a learning effect. As of now, you will not be able to understand what is the impact of learning effect. When we come to the forecasting techniques, at that time you can understand. As of now, also I am not teaching you what is the meaning of learning curve and the effect of learning curve. So keep it on hold. We will see that when we come to that particular topic, learning effect. Okay. Okay, we've discussed a lot, but unless and until we put that into practice, we will not be able to understand anything. Okay, it all looks so. It looks like it is clear, but it is not. Nothing is clear. That's the explanation part of it. So when we come to the questions which are there given to us, let's take up these questions and let's solve these questions. Okay, so on the screen from question number 39, we see question number 39 says that a manufacturer expects to use 4 kgs of material at a cost of 5 per kg. I hope you're able to see this one. On each of its produced units, budgeted production was for 5,000 units of a single product. In January, the manufacturer actually spent 82,764 making 4,400 units of its product and used 16,720 kgs of material. To the nearest, the favorable material price variance for April is dollar how much? I'm taking this question and the other questions which are there on the screen. Question number 39. We are asked to find out what is the, it's already mentioned that it's a favorable variance. The formula for material price variance. This talks about the difference in the price of the standard price and the actual price, the difference between the prices applied for the actual quantity, the total actual quantity. So actual quantity into the standard price, any order you can write. It is based on the logic which we would be mentioning that. So there are 3 variables which we need to know: what is the actual quantity, what is the standard price, what is the actual price. So we need to have all the 3 variables. The first one says that a manufacturer expects to use 4 kgs of material at a cost of $5 per kg on each of its produced units. So $5 per kg is what? What is that $5 per kg? Let's define all the 3. First, we need to know what is actual quantity. Then we need to know what is standard price. Then then we need to know what is actual price. If 3 variables are known to us, we can solve that. Simple. So what is actual quantity? Budgeted production was for 5,000 units of a single product. In January, the manufacturer actually spent 82,764 for making 4,400 units of its product and used 16,720 kgs of material. The quantity, we are looking at the quantity. So there are quantities mentioned. Here the quantity is mentioned as, the standards are mentioned as 4 kgs of material. So the the usage part of it, the usage part of it is expressed in terms of kgs. We are not talking about the output, we are talking about the input. Then how much actual quantity of material was used? It was 16,720 kgs of material was used. So actual quantity is equal to 16,720. What is the standard price? The standard price, they have decided that for every kg it would be $5. But how much did they actually spent on that? That we'll see. The quantity is 16,720. That's the actual quantity. The standard price is $5. Is the actual price given? We do not see that. Actual price is not mentioned. But it says that they have used 16,720 kgs of material, and they have actually spent 82,764. So if they have used 82,764 for 16,720 kgs of material, the price per kg of material is 4.99. I'll just put this one here in bracket for your understanding. It is 82,764 divided by 16,720. This is for your explanation. Can we write the formula now? Material price variance. Material price variance is equal to, just have to substitute that. The quantity is given as 16,720 into the standard price. It is already a favorable one because the price which they have paid is less than the standard price. The actual price is only 4.95, standard price is 5. So it's 836. No response from your side? Am I audible?
Yes,
Am I audible?
Yes, ma'am.
yes, ma'am.
Okay, okay, okay. 40th question. Which of the following best describes a basic standard? Just look into that and then tell me. A standard set at an ideal level which makes no allowance for normal losses, waste and machine downtime. A standard which assumes an efficient level of operation but which includes allowance for factors such as normal loss, waste and machine downtime. A standard which is kept unchanged over a period of time. A standard which is based on current price levels. Which one of them best describes a basic standard?
Option D, ma'am.
A standard which is based on current price levels. So current price levels, it reflects the actual prices. Um, First one says that a standard set at an ideal thing scenario, ideal situation never prevails. So ideally speaking, when should we have an ideally speaking scenario prevailing? So if it goes with that, so that the pressure on the workers would be very high because the situations which exist are not ideal all the time. So it should be practically possible to achieve. So that part of it. So on that note, A is not selected. Second one is a standard which assumes an efficient level of operation, but which includes allowance for here also it talks about assumes an efficient level of operation. This is also not possible because workers come in different capacities, whether they are equipped, they are skilled, they are unskilled, semi-skilled, all the time having an efficient level of operation without any breakdown, without any ideal time, that is also not possible. So on that note, B is also disregarded. C and D. she says that a standard which is kept unchanged over a period of time, a standard which is based on current price level. So current price level, how can they decide the standard based on the current price level? At the time of preparing that, that is prepared, that is decided prior to a given period of time. The practical, that is also not possible. So why should we select C? That's the point here. Why should we select C? Why is C the correct answer? Now, when the standards are decided, so initially one basic example I was mentioning about that. Maybe they must have planned at some 80,000 units activity level. So they have planned at 80,000 units activity level, but because of the demand or because of some reason, they have not operated at 80,000. They have operated at 85,000. So everything which is planned at 80,000 and the actual activity which is at 85,000 definitely are not comparable. A student in the fourth semester and a student who's in the sixth semester, definitely their level of comprehension is different. They are not comparable. Therefore, 80,000 activity level and 85,000 activity level are not comparable. So a standard which is kept unchanged over a period of time. Okay, so this is it has to be decided. We call this as flexible budget. This part of it is um, the concept is called as flexible budget. So what is that they are doing all the time? They are accommodating. They are accommodating according to whatever are the changes in the situation in that, which means that they were not efficient enough to estimate what would happen in the future. So once in a while, yes, there would be a possibility that it would change. Okay, but at the time of planning itself, so here it goes with an assumption that the planning itself at the time of it, the forecasting should be efficient. A standard which is kept unchanged over a period of time. So the standards when they decide, they should be the, I mean, ideally the best standard which can be taken is um, which is kept unchanged over a period of time. The cycle talks about the plans also have to be revised. Here, when they are revising according to that, it means that they were not efficient at the time of planning itself. So they have to alter this to make it possible to be compared with that. So if they decide these standards, that is not subject to changes. If they can decide at that level, then that is considered to be as a basic standard. We also call that as a fixed standard or a fixed, if it is flexible, the basic one is called as the fixed. D talks about when they are changing according to the changes, that will be called as flexible. So on that note, we see that which is kept unchanged over a period of time is a basic standard. There's some set of information which is given. X40 is one of many items produced by the manufacturing division. Its standard cost is based on estimated production of 10,000 units per month. The standard cost schedule for 1 unit of X40 shows that 2 hours of direct labor are required at $15 per labor hour. The variable overhead rate is $6 per direct labor hour. During April, 11,000 units were produced, 24,000 direct labor hours were worked and charged, $336,000 was spent on direct labor, and $180,000 was spent on variable overheads. The direct labor rate variance for April is 41. Question number 41. Labor rate variance is equal to, it's the difference between the standard rate and the actual rate applied for the actual hours into the standard rate. Any order we can write minus actual rate. If that is the case, we have to define all the variables. What are the actual hours? What are the standard rate? What is the actual rate? So actual hours is equal to, then standard rate is equal to, then we have actual rate is equal to. The details are the estimated production was 10,000 units per month. Standard cost schedule for 1 unit of X40 shows that 2 hours of direct labor are required at $15 per labor hour. Then the variable overhead rate is given $6 per direct labor hour. During April, 11,000 units were produced, 24,000 direct labor hours were worked and charged. $336,000 was spent on direct labor and 180,000 was spent on variable overhead. So there is a combination, the data which is pertaining to labor and also the variable overhead. They both are mixed together. First, we need to identify what are the actual direct labor hours worked. How many hours did they work? Can you see that and tell me? It's a combination which is given. During April, 11,000 units were produced, 24,000 direct labor hours were worked. Okay. What is the standard labor rate per hour? And then what is the actual labor rate per hour? Now these two things have to be identified. What is it? Yeah.
The standard rate 15.
$15 per labor hour. So 15 is the rate. What about the actual rate? The actual rate,
$336,000 divided by 24,000 direct labor hours.
okay. So how much would that be?
$14 per hour.
We have 336,000 divided by 24,000, so 14. Labor rate variance is equal to, labor rate variance is equal to, it should be 24 only. One only, no, is the difference. So this is equal to 24,000 into 15 minus 14. So that will be 24,000. But is it adverse or it is favorable? So this is cost variances. We are talking about cost variance. The actual price which they have spent was less than what is standard. Standard is 15, the actual is only 14. Actual cost which is spent is less than the standard cost. So it is favorable. Logically, that is how we have to present it. This is favorable variance. So on that note, which one is the correct answer? Answer would be answer is D. D.
Ma'am,
Yeah.
how it is favorable since the standard rate is greater than the actual rate, no, ma'am?
No, they have given a provision to spend to the extent of 15. Now, if somebody is giving you to spend 10,000, you save 1,000. You say I spent only 9,000. 1,000 is still remaining. So is that not a favorable scenario?
Okay, this rate refers to the cost price, ma'am.
Cost, yeah, labor variances, material variances, overhead variances, all of them are related to cost variances.
Okay, ma'am. I thought it was the selling
No,
price.
no, 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 no. Price. Don't get confused with the term price. Price or rate is about the what they have to spend. That is spending part of it. So it's a cost variance.
Okay, ma'am.
Okay, 42. The variable overhead efficiency variance. Efficiency variance, like we have it under labor, that is the usage variance. On the similar ground, we also have it for variable overhead. The third category of over variances are for the overhead. Overhead variances are divided as fixed overhead variance and then variable overhead variance. I'll give the list of what are the overhead variances. We will look into that. But on a similar note, it is the efficiency variance or the usage variance is the same. So let's put it as first, and then we will go through what are the list of variances we have. Variable overhead efficiency variance is equal to efficiency is about what is the usage, what is the quantity, what is the time. Here in this combined set, we have the number of labor hours. So it could be for the number of units, it could be for the number of hours. So anything is fine. The standard cost schedule indicates that 2 hours of direct labor at 15,000. The variable overhead rate is given as $6 per direct labor hour. Variable overhead rate. Then 11,000 units were produced, 24,000 direct labor hours. Then something is given about labor. $180,000 was spent on variable overheads. So the details which are connected to variable overhead rate is given as $6 per hour. Okay, so standard variable overhead rate, take that into the difference between the standard hours minus actual hours, because the rate is given per hour. So let's define what these are. Standard variable overhead rate is equal to, it's already given to us as $6 per hour. Then we have standard hours. Then we have actual hours. how many hours? So once again, let's look into that. Um, the standard cost schedule for 1 unit of X20 shows that 2 hours of direct labor is required. So for every 1 unit, 2 hours. So totally how many units were produced? 11,000 units were produced. So it will be 11,000 units produced into two hours per unit. So that comes up to be as 22,000 hours. So I'm writing it here. It is 11,000 units into 2 hours per unit. So that comes out to be 22. What are the actual hours?
24,000
That's
direct
right,
labor.
24,000. It's already given to us. Substitute that and then find out what is the variable overhead efficiency variance is equal to. So we got it as negative, but we don't present it as a negative item. We just write it as a positive figure. That's it. So 12,000 is the variance. But now here we have to remember what is more than what. Standard hours are less than the actual hours. So it is in 12,000 adverse. So answer should be A. Answer would be A. Overhead variances we'll see tomorrow, the next class, Tuesday's class. Too many things on single day. Why? So whatever we have learned, we'll continue with that in today's class. So let's take up 46th question, 46, 47, 48. Three things we'll take it up. 46th question. L uses a standard costing system. The standard cost card for one of its products shows that the product should use 6 kgs of material P per fixed unit and that the standard price per kg is 6.75. L values its inventory of materials at standard prices. During November 20x1, when the budgeted production level was 2000 units, 2192 units were made. The actual quantity of material P used was 13,050 kgs and material L inventories were reduced by 500 kgs. The cost of material L which was purchased for was 72,900. There are two things we are asked to calculate. One is the price variance and the usage variance. So let's calculate both of them. This is question number 46. We are taking it up. Material price variance. So I'll put it here. Material price variance is equal to, what's the formula? The difference between prices applied at the actual quantity into the standard rate minus the actual rate or price or whatever term sorry, actual. So we need to know three variables: actual quantity, then we need to know what is standard rate, we need to know what is actual rate. Okay, so do we have these things? The actual quantity of material P used was 13,050. 13,050. What's the standard rate? The standard rate is given as first paragraph. The standard cost card for one of its products shows that the product should use 6 kgs of material P per finished unit and the standard price is 6.75 per kg. What's the actual rate? The actual quantity of material P used was 13,050 kgs and material L inventories were reduced by 500 kgs. The cost of material L which was purchased was for 72,900. What's the actual rate? We need to find out what's the actual rate. One two into units per minute. I am not able to understand this sentence. So I'm really sorry for that. The sentence which is given is the actual quantity of material P used was 13,050. That usage part of it is applied in case of material usage variance. That is the quantity variance. What is purchased has to be understood. When we understand what is the purchase price, then we can apply this one. How many units were purchased is what actually has to be understood. So the budgeted production level was decided at 2000 units and 2192 units were made. So the actual output produced was 2192. The actual quantity of material used was 13,050 kgs. That's the usage part of it. But the material L inventories were reduced by 500 kgs. What does it mean by reduced by 500 kgs? Is they have purchased less the material less by 500 units because they whatever was there in the inventory they have used it. That's the meaning of it. The cost of material L which was purchased was 72,900. So how much was did they purchase is the point. If we know that, then we can find out what's the actual rate. um, how do we apply this 500 kgs is what I am trying to figure it out. That
And
logic is,
if
yeah.
they say that material inventories was reduced by 500 kgs, that means that they purchased insufficient
Huh,
material to the extent of 500 kgs.
that's right.
So does that mean that if they use 13050 kgs, that they actually purchase 13050 minus 500 kgs?
That is done. That is what is not striking. I mean, when I apply that, so they purchased. They did not purchase 13,550, but they have purchased 500 less. They have taken it from the um, already available inventory levels. So the rate would be 5.80, but this 12,283 answer is not there among the price variances. So that's where I'm stuck. So if we adjust that 500, they purchase less kgs by 500. So in that case, how do we figure it out? Yeah.
Actual quantity used will still, when we are doing it for material price, actual quantity will still be only usage quantity, not the quantity purchased.
I'm really sorry. I didn't. Your voice comes very low. So I'm really sorry. Would you mind repeating it?
Ma'am, for material price variance,
Mm.
when we are doing it, we take into consideration the rate that is purchased, not the rate that is
Huh. So
used,
what
right?
is
Not,
purchased only? So purchased is they purchased 500 less because that had an impact on the inventory. So from the existing inventory they have used. So if they have used 13,050 and it had an impact on the existing inventory, which means that they purchased 500 units less. So the
yes, ma'am.
actual,
I understand that, ma'am. My question is in the formula you write actual quantity into the standard price minus the actual price. Now,
Okay,
over
okay.
here,
Here also 12,550.
that was my question.
I know, I know. I am really sorry. Sometimes uh I know the basic logic also sometimes I am only focusing on the 500 kgs part of it. From that time, I'm just struggling to why I'm not able to get that. And thank you so much. Sometimes we don't get that. Oh, okay, thank you. Done. Let's proceed further. The logic is they have purchased less quantity by 500. So that part we understood. So how much less is they purchased 13,050 minus 500. So the total cost of 72,900 should be spread over these units. So the rate per unit comes out to be 5.808765. Done. Standard rate anyway, that part is already given 6.75. The usage part, how many units did they purchase? The purchase part of it, they purchased only 12,550. So the material price variance is equal to 11,812. Now let's calculate what is the material quantity variance. But the quantity variance is equal to applied at the standard rate into the standard quantity minus the actual quantity. What's the standard rate is equal to? Then we have the standard quantity. Then we should have the actual quantity which is used. Okay, so the actual quantity which is used is 13,050 kgs. The standard quantity, the quantities mentioned are the standard cost card for one of its products shows that the product should use 6 kgs. They have decided that the production should be only 2,000 units, but the actual output which was produced was 2,192. So how much quantity should be there for all 2,192? So here it will be 2,192 into 6. So, so it was is equal to okay, fine. So the material quantity variance is equal to which one is favorable, which one is unfavorable is what we will figure it out. The standard rate and the actual rate. Standard rate is given as 6.75, but they spent only 5.8081. So on that note, this becomes a favorable one. Coming to this one, they have allowed to use 13,152 kgs of material, but they consumed only 13,050 kgs. Therefore, also this one, it is a favorable variance. So 46. I'm sorry I took so much of time, not able to figure it out. In case of price variance, what is the quantity purchased has to be considered. So when we are talking about the quantity, the actual quantity purchased has to be considered. But in case of the quantity, the usage variance, how much was used has to be considered. So on that note, the answer would be option B. Answer is option B, 11,812.50 favorable and 688.50 favorable. 47th question. A manufacturer spent 244,000 or 9,760 hours of labor producing 6,000 units. However, only 9,480 hours were actually worked by labor. Labor should have taken 1.6 hours per unit at a standard rate of $24 per hour. What is the value of adverse labor idle time variance? Simple formula. What is the idle time? Has to be first understood. What is the standard rate? Okay. So idle time variance is equal to, find out what's the idle time. Idle time or unproductive time into standard rate per hour. Let's first figure it out what is idle time. Then what is standard rate per hour? A manufacturer spends some amount on 9,760 hours of labor. However, only 9,480 hours were actually worked by labor. So find out what's the idle time. Idle time would be 9,760 minus 9,480. That gives us the idle time. Standard rate per hour is given already as 24. So the idle time variance would be 6,720. C bit answer. Then come to 48th question. R uses a standard costing system and has the following labor cost standard in relation to one of its products. 10 hours skilled labor at 9.50 per hour. During March 20X9, 6,200 of these products were made, which was 250 units less than budgeted. The labor cost incurred was 596,412 and the number of direct labor hours worked was 62,890. The direct labor variances for the month were, so we need to find out what's the rate variance, what is the efficiency variance. Sorry, here it is hours, not quantity. The standard rate is mentioned as 10 hours skilled labor at 9.50 per hour. So During March 20X9, 6,200 of these products were made, which was 250 units less than the budgeted. The labor cost incurred was this one, and the actual labor hours worked given is as 62,890. That's the actual hours, 62,890. So now we have to find out what is the standard hours. Now standard hours are, see, for making in relation to one of its products. So 10 hours are required, then the rate is given. 10 hours are required. They planned for something as 6,200 minus 250, but the actual thing happened at 6,200. So taking that into consideration, we have to find out what are the standard hours for the actual output. Standard hours for actual output would be is equal to 10 hours into 6,200 units. So to produce 6,200 units, how many number of hours will be required? So labor efficiency variance is equal to, so here is equal to standard rate okay. So whether this is favorable or adverse, we can write here. The standard rate is 9.5, actual rate is less than the standard rate, therefore this is a favorable one. Coming to this one, the standard hours are allowed as 62,000, but they took more than the standard hours. So this is an adverse variance. So this will become A. On that note, we see that answer is option C. Option C, $1,043. Okay. It takes some practice. I don't know whether you've done standard costing during your BCom program, graduation program earlier. The way they are explained in many textbooks, some of the international books kind of look little complicated, the explanation and all. This is the most simplified, easiest way to remember. So if you can have a hold on these formulae, then you can do well in that. So the chart which I gave you, which classifies them as the cost variance, is split into the price variance and the usage variance. The usage variance, again from here, this is usage variance or efficiency variance. This again gets split up into the mix variance and the yield variance. This is the easiest way to remember the material variances and labor variances. I still have to explain about what are the overhead variances. Only one thing, because it had come in that particular sheet. So I have done that. But first we'll look into the explanation about what are the overhead variances. After that only we will take up the questions on that. So I think today's class, this much is sufficient. See, the textbook, the standard textbook of CIMA, also the presentation is little different, but they are touching about the same concept. The concept is nothing different. So I have simplified it here in this way because the Indian textbooks have given this in this simplified fashion. But the international material, what is available on variance analysis, has explained it in a little difficult manner. Don't be panicked. If you are thorough with this one, you can present this one also in the examination. Okay. We'll end the class here. So again, we would be meeting on Tuesday, but Tuesday to Friday, it will be only 1 hour class. So that week, maybe we will finish standard cost in the variance analysis and then start with the budgeting.